Today we're going to talk about something extremely important to your investing and trading process, and it's even more important in a market like the one we're experiencing now, a bear market. And what we're going to talk about here is position sizing. And position sizing seems simple, right? You just put some money into a stock and you make some money back. Well, unfortunately, no, it's not that simple. In fact, it's one of the most complicated and difficult parts of trading and investing, and it's also one of the most important parts, like I said, because it's going to determine how much you win and how little you lose. Position sizing is a big part of risk management, which we know is the number one thing that you need to do in the stock market to make money and be successful long term. So at Macro Ops on our podcast, we recently interviewed Alex Morris. He's at the Twitter handle TSOH Investing, and he publishes a lot of great stuff there and on his newsletter. And when we asked Alex about his biggest struggles as an investor over the last year, he didn't say that it was analyzing a business or choosing an investment, it was position sizing. So in Alex's case, he's more of a long-term investor. I'm talking like years or even decades. And even as a long-term investor, position sizing is very crucial. So he said just thinking about how to navigate stock price volatility, like 50% moves, which in his space can absolutely happen over a number of years. He said in theory, you go, it's all just internal rates of returns, it doesn't matter, but for him, that's just too theoretical because he spends so much time thinking about individual businesses, and he was a buy-side analyst formerly, so he really gets deep into it. But even though you could spend all that time on the business, it's building all of that together into a portfolio with the proper construction. That's the more sensible way to do it. And that's the importance of this. We always say on this channel and at Macro Ops that stock picks don't really matter. Well, they matter a little bit, but more than that, the point is that trade management is what matters. Because you could find an amazing stock and just screw it up. And we've all had that happen, right? We get into a stock and it doesn't move or it drops, so we sell out. And then all of a sudden the thing takes off without us. And then we're kicking ourselves because we're thinking, hey, I knew that was a great company. I knew it was going to go higher. But the trade management screwed it up. And a simple answer might be, hey, that's why I'm a long-term investor. I'm going to hold it for 20 years. But as you can see from Alex Morris's case, he says that doesn't work either. You still got to be thinking about position sizing, even if you're going to hold for 20 years. So one example is Spotify, which Alex was a big fan of. And for him, out of the gate, Spot was always a 5 to 10, 20-year story for them to reach a sustainable profitability and scale. So if you're that long-term, once again, position sizing becomes a big aspect. Because if you're going to wait that many years, then you should be way more conservative from the beginning, taking a smaller position. What you learn in practice is when you own something for those first 1 to 3 years, and the business results really suck and shake the foundation of what you used to believe and what you should believe, well then there needs to be some markers in the ground to test the thesis. You can't just place a bet and reassess in year 20. That's crazy. Because at the end of the day, what are you trying to do? Make money, right? And the only way you're going to make money is if the stock price moves higher from where you bought it. Doesn't matter how amazing your fundamental thesis and how great the company is in your opinion. If the market doesn't see it and the market's not moving, then you're losing money. Because not only do you lose money from the stock price going down, but you also lose money from just putting your money into a dead position. So if you invest 50% of your money into, say, Spotify and you think it's the best, and it doesn't move anywhere for 5 years, well, your money didn't do anything for 5 years, right? That's why putting on that smaller position is smarter. So you can kind of put a stake in the ground and monitor it and see when it actually takes off, when the market is saying that, hey, now's the time to get in. Now this sounds easy, but it's really not. Position sizing is one of the things that every manager struggles with. And really there's no one size fits all answer. It depends on a number of factors such as personal and LP risk tolerance, and LP is your clients, portfolio volatility, return objectives, investment style. There's a lot of different factors. Now another example of why you need proper position sizing is not only in individual stocks or positions, but it's also for the total market. So you've seen what the market has done over the last few months, right? It's just been collapsing. And every time it looks like it's about to turn around, what happens? It gets smacked down lower once again. Now I've been getting some criticism in the comments lately saying, hey, I keep calling for a bottom, but then the market keeps falling lower. Well, when those people criticize me, I know they didn't actually watch the video and pay attention. Because what is the name of this channel? It's Fallible, right? So as new information comes in, we're going to adjust what we think about the market. And in this case, what we've been saying for the past few months is that we have gotten multiple potential bottoms. But guess what? They didn't work out. We can go back to this bottom right here. We thought we were going to get a multi-week move higher. But then what happened? That inflation print came and we headed lower once again. And this is where position sizing and trade management come into play. Because even though we got our technical, fundamental, and sentiment signals that the market was going to turn around here, we knew we still had to manage in case some surprise number came out. which it did, and this thing turned around. So if we thought, okay, this is the bottom for sure, and we put all our money back into the market, what was going to happen? We'd take a big loss when it turned around again. Instead, what we've been saying is that, hey, this is a potential bottom. We're going to test it a little. We're going to put on some small positions. And that goes into position sizing. By putting on those smaller positions, we're able to test the waters and see what happens without the risk of losing a bunch of money if we're wrong. And guess what? You're going to be wrong a lot in the market. Some of the absolute best investors and traders like Peter Brandt, Stan Druckenmiller, they have win rates of 30%, meaning they're wrong 70% of the time. But the reason why they're still able to make so much money is because of their risk management and position sizing. So on their losers, they're size small so they don't take that big of a hit. And on their winners, they're size bigger. So they're able to get way more profit that makes up for all their losers plus more. So we've talked about this before in our position sizing in the macros portfolio. We size in slowly into things. So we put on the exploratory position, which is a smaller one. And as the stock moves in our favor, we keep adding more and more. That's how you layer in or stagger into a position. And going back to this general market, calling bottoms is stupid. We look at the data and we say, hey, there might be a potential bottom here. Like again, we said this might be a potential bottom, but we were still waiting for yields to do the right thing and not keep rising. But we don't know if that's going to happen. I mean, look at this. The market's already turning around again. What does it mean? Once again, we're waiting. Is it going to make a lower low or is it going to stop right here? You got to wait and see a lot of the time. And it pays to have smaller positions when you're doing that. We were putting on a little bit of risk during this up move. Now we're going to see if it's going to play out or if it's not. And if it's not going to play out, we're not going to lose that much when it turns around. That's the power of position sizing. And in a bear market like the one we're in right now, I know a lot of people are losing. And that's where position sizing can come in and help you as well. Because if you're losing a lot in a row, you can lower your position sizes. We actually had an article on our Substack about it, position sizing and drawdowns. No trader can escape drawdowns. They're a reality of the business because the market gives you profits and cycles. So one of the best things you can do when you are on a losing streak is to scale back your position sizes. And that's kind of the key to having a long trading career, right? Staying in the game, making sure you don't blow out. Because a tiny drawdown in your account, and when we're talking about drawdown, we're talking about your equity high and how far you fall from that equity high. So say you're up 20% and then you fell to 15%, that's a drawdown of 5%. And the drawdown isn't over until you hit a new equity high of say like 21%. So a tiny drawdown, if left untreated, can quickly turn into a blow up of account capital and mental capital. And in our case right now, in a bear market like this, account capital is one thing, right? Yeah, people are losing. But mental capital is the big thing that people are losing more than anything. Because again, this is not fun. All these false starts and then just dropping lower. False start, dropping lower. It weighs on you mentally over time, and that can affect your trading, and it usually does. So if you lose either of those two types of capital, mental or account capital, you're out of the game for good. You never want to let your mental state get screwed up. So if we look at drawdowns, they're really a sign that either your method is temporarily misaligned with market conditions, which is fine long-term, again, depending on your strategy, because the market does work in cycles, or your edge could be eroding and you need to adapt, meaning your strategy was not built to last through different market cycles, or you're making trades outside of your expertise or your normal process. You're getting sloppy. It happens. In those times, which is why you would be experiencing a drawdown, it makes sense to reduce your position sizing. Because in the moment, you don't know exactly what's happening. But lowering the size slows the process and gives you time to think about it. So in scenario A, where your method is misaligned with market conditions, a smaller size makes it mentally easier to weather the storm. So this is an example if you have a strategy that's, say, long only. Well, you're going to get beat up in this, right? So one thing you can do is lower your position size. That way, you could still keep executing your strategy, but you're losing less because you know the market isn't totally aligned with it right now. And the reason you would keep executing it is because you don't know when the market is going to fully turn around either. Now for scenarios B and C, which are your edge is getting messed up or you're getting sloppy, smaller position sizes will protect your capital and buy you more time to make the adjustments you need to make to get back on track. So here's a methodical way to determine when and how aggressively you should reduce your size. First, look into your trading history. Do your losses cluster? Are they sprinkled around winners, which is okay, or are there clear areas where a few losses lead to more losses in a row? If you see a pattern of loss clustering, then you should probably reduce your size because it becomes kind of predictable. And it's usually a series of losing trades that you're looking for. That number could be 3 or more, but it depends really on your strategy. Are you short-term, long-term? You're going to have a different amount of trades. But the point is that you want to evaluate your trading history to try and determine the optimal threshold. So for example, if you find that after making 3 losing trades in a row, things start to get dicey for a few months, then the next time you run into 3 3 losers in a row, you should start to cut back on your size. So this is really, once again, knowing about your own trading strategy and your trade management process. And you could keep cutting back on size until that drawdown stabilizes. And then once you see your equity curve going back up, meaning things are working for you, add the size back in. You can even get more complicated with it, like a real quant. So you could actually chart your own equity curve and have trend following rules for it. So if your account value based on closing trades is above a 20 trade moving average, then use full size. If it falls below that 20 trade moving average, then back off. So again, how you position size is going to depend on your strategy. But the point is, it's something that you really need to focus on, especially during losing periods. And a lot of people are losing right now. The way we do it in our Fallible strategy is more standardized. We always take 20% positions. And that 20% position, when we back tested it through every type of market scenario, it works. And when we say it works, we mean that it works over the long term. If you want to learn our Fallible strategy and how we position size and how we just manage trades in general, then make sure you check out our free training here. I'll put a link to it in this video and down below in the description and comments. It's a quant system, so everything is calculated and laid out, and that's how I like to trade. And that's how I like to position size too. So definitely check that out, and once you're done with the training, check out this video right here. Ray Dalio talks about how we might be heading into another 1970s inflationary style period, which will really suck. But it's important to know about. So check out that training and click this video, and I will see you there.